just the profit portion.
Right. Yes.
So which means to say if...
Because you don't have all the revenue under your books.
Precisely.
Because there are other joint venture partners.
Precisely.
But you can't all count the same revenue
that's correct.
Multiple times.
That's correct. So therefore, if the joint venture partners only... So if the income comes from the JV, in this case, and they chose the equity method of accounting, so what it means is that they will only add the profit line, but not the revenue line.
Not the revenue line,
So
right.
you can see that in the income statement over here. Again, highlighted, share of results of joint ventures. So a single line addition, it adds to the profit, but it doesn't add to the top line, the revenue. So that explains why revenue and profit is quite different in this case.
Let me take a quick time out here and ask you a very quick question. The first is, we're just still looking at that income statement.
Yes.
What is the difference between the group, as you can see at the top of that column, and the company, which is often very different numbers?
Precisely.
Which one should you be looking at?
So the company will refer to the investment holding company, right? In this case, the listed entity, CapitaLand Holdings. The group will comprise all the operating subsidiaries plus the holding company.
So which one should investors be looking at?
So take a look at the group numbers because that gives you all the operating information in this case. So you can see the numbers are very, very small for the group, for the company as compared to the group level, because that's when you get to see the real operating data.
Right. Let me ask you one other question, and that is about EBIT itself. During the dot-com bubble about 11 years ago, there were all number of startups that reported fabulous EBIT numbers, and then they came up with another term, EBITDA, right? Earnings before interest, tax, depreciation, and amortization.
That's correct.
And, you know, I mean, in theory, you could have extrapolated that to any number of ways in order to suit yourself.
That's right.
So what is the difference between EBIT and gross profit, which people may be more familiar with?
Okay, so gross profit in this case is simply your revenue less your cost of sales.
Right.
So the EBIT is really taking your profit before tax and after, and you add back what's called your finance cost. And the purpose of doing that is really quite a common way for a company to assess the performance, because taxation and also interest costs, they are very, very different, because tax policies is quite different from the operating policies of the company and how well managers manage the business. So tax is normally handled at the group level. Operating managers not accountable for the tax
yes,
most
of course.
of the time.
I mean, what can they do about it?
Precisely.
Right? They're not there to manage the tax man. They're there to manage the property business.
Precisely.
In this case.
And the interest portion of it is usually again handled at the group level in terms of at the CFO level in terms of financing. Do I get more equity finance or do I get more debt finance? Again, the operating managers normally do not have a big say as to how the finance of the company should be structured.
Right, understood.
So,
so in other words, earnings before interest and tax, EBIT, is net profit minus finance tax. Is there a different way that we could look at this? It's gross profit plus... EBIT is gross profit plus...
Okay. Another way of a simple way of looking at this, Mark, is this. You have your gross profit line on top, you have your profit before tax, so your EBIT line is somewhere in between your gross profit and your profit before tax. Right. That might be an easy way to visualize that.
Good. Thank you for the clarification. Let's move on. And we're still talking about EBIT at this point, or are we moving on to tax? Sorry, on profit before interest and tax.
Yes, we're going to move on, right? We're going to look at PATMI, the third zone of the revenue or the income statement. So we talk about revenue, we talk about EBIT, now we take a look at what's called PATMI, profit after tax and minority interest. So what's really important with regards to this line here is that, so it's net of minor shareholders, minor shareholders' share of the profits, and very important to know whether the profits of the company are sustainable. And if you take a look at this,
This is the summary now.
This is the summary now from, again, the analyst briefing. And what it tells you here is that they have the fifth consecutive year of PATMI above 1 billion, which demonstrates to you sustainability. Because one of the things that we want to look at in terms of the company's performance is sustainability of earnings or quality of earnings. Are they repeatable?
Yes.
Yeah, so that's one indication of that.
Okay.
Okay.
Good so far, so good?
So far, so good.
All right, and now I see that you've gone on to interest cover and the debt to equity ratio and so on. What do we see in this graphic?
So we have moved away from performance. So assessing the performance, how well did the company perform? What's the revenue, the top line, and how much do you earn for shareholders as income? The next thing we're going to assess would be will shareholders be able to sleep peacefully at night?
Because we want to know whether it's a strong company.
Precisely. So to gauge financial strength of a company, we need to look at the balance sheet. So in the balance sheet, we look for strength and safety. So one of the key ratios we're looking at is what's called interest cover, in which case you see here it stands for EBITDA, which is earnings before interest, tax, depreciation, and amortization.
Yes.
So based on the income or the profit that they are making, are they able to cover their interest expense?
Keep the bank manager happy.
Precisely. And you notice that it has grown from 4.54 times to a 7 times cover, which means to say the strength has grown. Ability to service has gone up.
Okay, and you've got one other line highlighted there?
Precisely. And the next line here is called the debt to equity ratio. So the debt to equity ratio is very, very important because what it measures here is that for every dollar of shareholders' money, how much money are you borrowing? So in this case, you notice that out of every dollar of shareholders' money, they're borrowing 9 cents, 0.09.
Last year, or is
last
that this
year?
Last
that was last year. And this year, 0.18.
Okay.
And so what you can tell on an absolute basis, it doesn't look like a big number. So it's something that the company...
It's increased, but it's not not like it's like for every dollar they're borrowing a dollar.
Precisely.
Right.
And in fact, management is quite comfortable at even a 0.5 debt to equity ratio.
Right.
And you can see
and they've actually said that.
And they actually said that. So they say that assuming that we work on a debt to equity ratio of 0.5, they could quite easily generate another $6 billion of financing capability to fund growth.
So it looks like the balance sheet still has some flexibility. I guess that's what you always hear in the news,
Precisely.
right? When people say that the balance sheet is strong.
Yes.
What are some of the other points that we need to know from the balance sheet, though?
Yeah. The other area that we need to focus on is also what is known as liquidity risk. And the next document we'll look at really comes straight from the risk statement from the company in the annual report. One of the things that they advise shareholders to look into will be the liquidity risk of the company.
Well, what does that actually mean?
Precisely. So taking a look, liquidity risk is the risk that the group will not be able to meet its financial obligations when they fall due. So meaning to say if all the debts were due tomorrow, short-term debts were due tomorrow, will they be able to pay off the debts easily, relatively, with great ease?
Right.
So how do they go about doing it? So for us to do that, to assess that, one of two things that we're going to look at, one is called the debt maturity profile, and also the operating cash flow, which will come later.
So when we look at liquidity risk, what does the balance sheet actually say?
Precisely. So taking a look at the balance sheet, this is what we can see. Net debt to equity ratio, we already saw that. And you take a look at their percentage fixed rate debt. So you notice that the maturity has gone from 3.5 to 3.7 years, which means to say they have more time to pay. At the same time, the percentage of fixed rate debt has gone up from 66% to 72%, meaning to say they've also in a way hedged themselves for increases in interest rates.
Yeah, and the interest rates are very low at the moment, so
Precisely.
in theory they can only go up.
Precisely. Any moment you could go up, and therefore they are doing the right thing by managing that part of the balance sheet.
Got it.
Yeah.
Okay. Now, one thing though, James, you're an accountant.
Yes.
I'm sure you've heard this phrase too. Profit is opinion, cash
Precisely.
is fact.
That's right.
In other words, we could, people like you are hired to figure out the profit. It's not like looking at the bank statement and saying how much cash do we have.
Right.
So let's now look at, we've looked at performance, we've looked at strength, let's look at health and how much cash they actually have.
Okay. The cash that they have, we have gone through earlier on from the balance sheet. We know the cash balance was $7.2 billion. So we just go back to the
down slightly
before,
from 8.7.
Yeah, precisely. And the other thing is the ability to generate cash flow. Are they able to sustain the cash flow? It's not just a one-time cash balance only. It's here today, gone tomorrow, but ability to continuously generate cash is really, really important.
Well, that's what business is all about, generating
Precisely.
cash.
So we can get that from the cash flow statement, and you take a look at this, again highlighted. Net cash generated from operating activities, as you can see. So that's the cash generated from the core operations. And in fact, it has gone up.
Yes. So they've collected checks and telegraphic transfers and so on of more than $900 million.
So that's the amount of cash they're able to generate from the core business, which is very important. Yeah, sustainability as we can compare to the year before. Now, the other thing we can tell from the cash flow statement is not just you generate cash, but you hoard cash. That's not very useful for a company as well. You want to be able to deploy the cash.
It sounds well and good actually to have lots of cash in the bank, but if you're earning less than 1% interest on it, yes, it's not much use there.
Precisely. So therefore, we can take a look at what do they do with the cash, and we look at the net cash used in investing activity.
So what did they invest in other words? How did the money flow out?
How did the money flow out? So you can see that there was a net investment of $1.8 billion last year. And where did it come from? And you can take a look at the next slide, that they have invested in buying different subsidiaries during the year.
Right.
So we're continuing on the growth path.
So this is not expenditure. This is not money out the door.
Yeah.
This is money invested in, well, hopefully other businesses that will make more money for.
Precisely. And you can also tell that from what management is saying they're going to do. With the cash that they already have on hand, $7.2 billion, with their ability, the financial flexibility that they have to be able to generate at least another $6 billion if they choose to, increase their debt to equity ratio, with the ability to sustain their cash flow from the CFO or the cash flow from operating activities, they are ready to seek $5 to $6 billion of new investments in 2011 to invest in sustainable growth.
Right. James Leung, it's great to have you with us. Thank you so much for talking us through it today. James Leung, the Chief Executive of Vision One Consulting. Now that you've gone through the annual report, in video form at least, now it's time to read the actual document. And the Chief Executive of CapitaLand, Liu Man Leong, will be very eager to hear your very sophisticated questions at the AGM.